Good evening, everybody. Tonight we've got Bill Johnson with us, which is a great honor and privilege. I've known Bill for, I can't even imagine how many years now. But he's probably one of the leading experts on option trading, risk reward, and he's going to be doing quite a bit with us as far as our option trading area here at the Candlestick Forum. So tonight he's going to give a good introductory options again from A to Z. So Bill, very good to have you back with the Candlestick Forum. We're anxious to see your information.
Thanks so much, Steve. Thanks. And like you said, we go back a long ways. I think it was probably 03 or 04 we met, worked on and off, and it's always an honor to work with you. And welcome, everybody, all the traders out there, candlestick traders, obviously, and hopefully some future options traders. And tonight we're going to talk a little bit, do what I would call more of a survey class on options, because we've got different levels in here in the room. I want to make the important point about why options are so important, especially for volatile markets. And anybody knows markets have been today, not being an exception. And how can you get those profits? How can you get in there and trade but still protect your profits? How can we hold out for more profits but also take profits off the table? And there's lots of neat little tricks like this that we can do if you understand options. So tonight, I'm going to take a little different tack from what I normally do when teaching. I usually like to make it interactive, a little more casual. But we got a lot to pack in here tonight, so I'm going to ask if you can hold off for the questions until the end. It would be very appreciated because I'm going to try and get everything in. I'll hang out as long as we need to do Q&A at the end. So let's go ahead and get started. And a little introduction about myself. As Steve said, my name is Bill Johnson. Pretty easy to remember. I was just checking some of the sound. Okay, it looks like everybody can get sound okay. And I have been in the finance business most 23 years. I was an active trader options specialist with Charles Schwab for 6 of those years. Back in that day, we cleared 30% of the SIBO's volume, more than any other firm on Wall Street. So when I tell you that I have seen everything that can happen with an option, good and bad, that is not an exaggeration. And I like to share some of those war stories with people in some of the training classes. I do hold a master's degree in economics, went back and got an MBA in finance. And then I also occasionally am an adjunct professor for FIU, Florida International University in Miami, teaching a financial engineering class. So I think one of the things I can bring to the table is to bridge this gap between the applied side of trading, the real-world applied side, and the theoretical. And both are important. So we'll touch on a little bit of it tonight, but when we get into the actual training classes, you're going to find it quite fascinating. I've also published 10 books on my own. I do a lot of ghostwriting. I've published about 7 or 8 on behalf of other people. In fact, one is a politician right now running for an office, so do quite a bit of ghostwriting, but everything in the field of finance and economics. So that's a little background about me, and now it's all time for you. How can you become a better investor or trader by using options? And I don't care who you are, what your trading style is, short-term, intermediate, long-term, swing trading, you name it, I can make you better by using options. And so my goal tonight is to not really teach all the nuts and bolts about a specific strategy, but instead to just show you why options are so powerful. It's going to be a 2-part presentation. First part's going to be option basic. A lot of people here who probably don't know what an option is. It's a little hard to talk about them if we don't at least talk about the basics. How will you benefit? Then we're going to talk a little bit more about some advanced topics. What is hedging, rolling, and morphing? And that's really where the heart of the option advantage lies. How can you lock in gains but stay in the position? Okay, that's an important topic. In fact, I saw somebody in here saying, take those quick profits before the bears get you, and that's a common theme. The problem is that if you always take quick profits, what's bound to happen? Even if it's one time, you're going to get hit with a day like this, have one large loss, and it's going to eat up all those small gains. So what we want to do is to let our winners run but to guard the downside or the upside if you're playing the short side. So how can we do that? How can we hold on for bigger, better profits? And that's important because trends always last longer than people expect. And we want to be able to grab those profits. So let's start off with part one and talk about some of the basics. First of all, options. They are a derivative instrument, one of many types of derivatives. And I know what you're all thinking is that, I've heard about these before. That's what blew up Barings Bank, and you saw the movie The Big Short, all the negative things. And there's part truth in that. But it's not because options are dangerous. It's because they are powerful. And if you're using powerful tools in improper ways, yes, bad things can happen. So we have to learn what they are and how we can use them safely. But they're called derivatives because the price is derived from the price of the underlying stock. And again, I put this little international symbol sign for no because that's how most people react when they hear the word derivative. But an analogy I like to give is a knife in the hands of a skilled surgeon can save a life, but you can also take a life. You can also choose to, juggle machetes on a unicycle riding across a tightrope. But that doesn't mean that you should complain to the hospital. There are safe ways for using them, and there are dangerous ways. What I want to show you are some of the really safe, powerful ways that you can become better traders. So let's start by talking a little bit about what in the world is an option. Well, they're very simple. They are contracts. You all know what a contract is. Signed a contract when you sign up with a credit card, bought a house, rented an apartment. It's just a contract. But these are standardized contracts. And that just means they're kind of like a cookie cutter, and that allows them to be freely traded back and forth. Just like shares of stock, right? My 100 shares of IBM is exactly like the 100 shares that Steve has. There's no difference in them, and therefore I can buy mine and sell against his. It doesn't matter. It's the same idea. So if we have contracts that are standardized, it allows them to be freely traded, and that's what makes them powerful. But the basic idea of an option is that they allow you to buy or sell 100 shares of stock. And for some of you who might be advanced, that's not 100% true by today's standards. We do have some mini contracts that'll do 10 shares. But the basic bulk of all your contracts out there are for 100 shares of stock. They allow you to buy or sell at a fixed price. So we predetermine that price. That's set up front. That's part of what will also make these options powerful. A given period of time. We can't use them forever. Now we can select different expiration dates from as little as a week, months, and almost out to 3 years. Although there's an SPX contract that goes out 5 years, but that's more for institutional traders. The exchanges have even filed with the SEC to do dailies, options that will start trading on the morning and expire in the evening. So for the most part, though, we're looking at months to. We have two types of options. And this is one of the things I find so interesting, that with all the powerful strategies and wonderful things we can do, it all comes down to two different types of options. So if you know these two things, it's going to get you ahead of the curve. There are call options and there are put options. Now a call option has the owner, that's the person who buys it, has the right to buy 100 shares of stock at a fixed price over a given time. If you purchase a put option, you are the owner. You have the right to sell, or to be the short side, to sell 100 shares of stock at a fixed price over a given time. Notice that both definitions are identical of that one word, buy or sell. And you're going to find out most people always think that calls and puts are different. They are far more alike than they are different. The big difference is that calls give you the right to buy, and put options give you the right to sell. So where do these names come from? I know people always say, what? Why would you call it a call option or a put option? That's weird. Well, yeah, it is, but there is a method to the madness. Call options got their name because what you're doing is you are calling shares away from another trader. So if I buy a call option, it's almost like I'm saying, hey, Steve, you know what? I'm going to call those shares away from you. In other words, I'm electing to be the buyer. If we do a put option, I have the shares back to somebody else. So Maybe I've got 100 shares of IBM. I bought a put option from Steve. Steve was the seller. I say, you know what? This price has really taken a hit here. Here you go, Steve. I'm going to put him back over to you. I am forcing him to be the buyer. Okay, so that's really where they get their names. So call option gives you the right to buy because you're calling shares away. Put options, you're saying, I don't want them anymore. I am the seller. Now, you're probably thinking this, let me show you how easy it is. And I like to always show analogies. We could make analogies with doing layaway plans, rain checks. One of my favorites is to use it like a coupon. Okay, we all know what these are. We get them stuck on our windshields at local shopping malls all the time. But a call option is very much like a pizza coupon. If you understand what's going on with this pizza coupon, you'll immediately understand the basics of a call option. So think about this. If you are in possession of this pizza coupon, to buy it or to use it? Not at all. It's a right. It's the same thing with an option. A lot of people are under the misperception. They say, if you buy that call option, you're eventually going to have to buy those shares. That is not true. It is a right. But what is that right? It's a right to buy something. It's specified in the, I don't want to call it this is not a contract, but in the coupon here, but in the call option, it's specified in the contract. It is a right to buy something, 100 shares of IBM, 100 shares of Priceline. But it's a right. If you decide to use this coupon, what's your price going to be? It's fixed at $10. What if the price of dough or pepperoni or something goes through the roof and they say, sorry, pizzas are now $30. Doesn't matter. I've got a coupon that says I'm locked in at 10. What if they're $50? Doesn't matter. I'm locked in at 10. That's one of the big things that gives these options power. We have a locked-in price that never changes. And then finally, like all coupons, we have an expiration date. Okay, so right to price over a given time. Now, we also have a component to these options that are called a strike price, also called an exercise price. And so if you have, let's say, a Microsoft $50 call, that number right there in yellow, the locked-in price, the $10 that was on our pizza coupon, is called a strike price. The proper name is probably more exercise price. Strike price is slang term, and it gets its name because that's where we struck the deal. Sometimes you hear people call it a striking price, but that's the price at which we're locked in. Okay, and it's also called an exercise price because if we choose to use our pizza coupon and walk up to the counter and say, I want to buy this pizza, in the options world we say, Mr. Broker, I want to exercise this call option, and I want to buy 100 shares of IBM. It's not a big process. You click on a little button on your platform that says, do you wish to exercise? Yes, boom, you're gone. You exercised it. But that's the term that we use, is to exercise it. So if you exercise your call, the price you pay is the exercise price, that locked-in price. So sometimes you're going to hear me, sometimes you'll hear me call it an exercise price. They mean exactly the same thing. So here's an example. Here's one for you to try. Let's say we're looking at Microsoft July 50 call. Now, this is more for artistic license to give you a good visual. There are no such things as certificates for options. Okay, so they're just what's held in what's called book entry, which means there's just an electronic entry on your broker's platform. But I want you to think of it like this. If you are in possession of this, what do you have? Think of it like your coupon. You have the right, not the obligation, to buy 100 shares of Microsoft for the fixed price of $50 per share through the expiration date in July. Simple. Another little quirk in the markets, it's, the markets are always changing, always updating and creating new products. Options back in the day always expired on the third Friday of the expiration month. And actually, that's not even true. They expired on Saturday following the third Friday. That was more for legal reasons, for clearing. The last trading day was always the third Friday. So you could count 3 Fridays down, and that was the date that it would expire in July. Now, why that date? Little trivia question. That was the time when it had fewest conflicts with holidays and exchange things like that. It had the fewest interruptions. So that's how they originally came up with that. But nowadays, we've got weeklies, we've got end-of-month contracts for the S&P, there's all kinds of different expirations. But right there on your broker's platform, it's going to say this expires in 17 days, or this expires in 360 days. It will tell you that that's how long you have to be in control of this coupon. Now, put option is the same idea, but you want to think of it more like an insurance policy. So here we are driving down, and this big tree jumps out right in the front of the middle of the road, and we wreck our car. What do? Are we required to report an accident? No, you're not. You can say, yeah, it's a little fender bender, I'll just take care of it on my own. But if we choose to, I can say, you know what, Mr. Insurance Company, here you go. I am putting it back over to you, and in exchange, I'm going to get cash. That's the best way to think about a put option. I don't want my shares of IBM anymore. I bought them for $150, and now they're down at 90. And you know what? they're totaled. From my perspective, I just want to get rid of them for 150, and I have the right to do that. Now, as we get more advanced, you'll also find out I could sell that contract and just take the cash and keep my shares. But conceptually, I want you to think of it as though we're selling those shares. So if we have a Microsoft July $50 put, same idea, right to sell 100 shares of Microsoft at a fixed price over a given period of time through the expiration date in July. So if Microsoft is at 40, how much are we going to receive? 50. What if it's at 30? 50. What if it's all the way to 50? Okay, now you might be thinking, well, how do I know the other person is not going to back out on this deal? Well, technically, there's not really another person on the other side. There is after the assignment. One person will get it. But you're really trading through the exchanges. And so if Steve wants to sell this put, he has to, if what's called a naked put, selling it by itself, he would have to post a margin requirement. And the brokerage firms are always going to make sure that he's maintaining that just in case he ever gets these shares put to him, what's called an assignment. So since 1973, when when options first started trading, there has not been a single default, meaning that anybody who decided to buy or sell by using an option, it has always gone through. So it's a pretty neat little system. So if anybody's wondering about that, you're not really paired up with another person. Even though sometimes I will say that, I might say, hey, if Steve sold me that call option, that's really how it works. But it helps you to visualize it. You're really buying and selling from the exchange. So we just talked about that buyers have rights. Okay, and the reason they're called options is that it's your option to choose. So I've got this call option. Do I want to exercise it? No, my choice. It's my option. You own a put option. You want to sell your shares? It's your choice. It's your option. Right? So it's always a right. Don't ever think that you have obligations as the buyer. Some other terms you need to know. Premium, just like it is in the insurance world, the price you pay for an option is called the premium. So if you pay $3 for an option on the broker's platform, just like you see the price of IBM or Priceline, anything on there, options will be priced per share. And that's what we call the premium. So if we see a Microsoft $50 call trading for $2, that doesn't mean $2. It means $2 per share. How many shares are in a contract? 100. So that would really be $200 plus commissions. So that kind of throws new traders when we say, well, you could pick up another 10 cents if you did this with this contract, or you could. We don't really mean 10 cents or $2. You have to multiply it by the number of contracts. So just keep that in mind whenever we talk about the price, just like it is for shares of stock, it's per share. So we've talked about option buyers. Well, you cannot be a buyer unless there's a seller, just like the stock market, really like anything else, car market, there has to be a seller. Sell an option? You can. Steve can. I can. Anybody can sell. Just like shares of stock. Can you buy shares? Sure. Can you sell them? Sure. Just depends on what we're trying to do. However, we get a little different perspective here as the seller. If option buyers have rights, what do the sellers have? You always have to think in opposites. The only way that you can make a buyer and a seller match is that... Anything on the screen? Are we getting screen? Are we projecting on the screen? I'm assuming you are. I haven't seen any other... Okay. All right, good. Thank you. So everything is always in pairs. So with the options, if the buyer has a right, the seller has an obligation. Exactly right, Samuel, an obligation. So sometimes people's market work. If I want to exercise my call, well, how do I know the seller's not going to say, well, I'm going to exercise my right and not sell them to you? It's because they don't have a right. They have an obligation. Okay? So we have an obligation. You might also think, why in the world would we want an obligation? Well, if you put an order to buy 100 shares of, let's say that IBM's trading at 150 and you say, I want to put a limit at 149, guess what? That's an obligation. That order triggers and fills. You can't say, I was only kidding, I don't really want them. That's a legal obligation. So anytime you've done anything in the financial markets, you have taken on obligations. You put in a market order to sell your shares of Microsoft. That's an obligation. So don't back down from the word obligation, because we're going to find out many of the strategies use pairs of options. They're called some spread strategies where we want rights and obligations. Okay, but for right now, I just want you to understand that sellers have obligations. How do we get those? Think of your auto insurance broker. You go and buy an auto insurance policy, what do he really sell you? He sold you a promise. You don't walk out with anything. You don't get a box of anything. You didn't really buy anything. Somebody's promise to say, I accept the obligations in this contract. And that's what you're doing as an option seller. You're saying, I am ready, willing, and able to take the opposite side of your trade. And what's really happening with the options market, the reason it was developed, is that we can now start partitioning risk. Steve might not want to buy 100 shares of IBM, but he said, if I can buy 100 shares of IBM and buy a put underneath it, I'm willing to do it. And guess what? We now have more buyers. And we also have somebody who got paid by selling him that put. The market becomes more complete and more efficient. So again, a little different perspective. Most people think that options are just legalized gambling and they're just it's Vegas on Wall Street. It's absolutely not true. They're more of an insurance policy. So, you're probably thinking, this is getting a little confusing. Let me show you an easy way to figure this stuff out. I always like to show nice little mnemonics or tips and tricks to remember things. When you're starting, you've got to go through these motions, give yourself time, and it'll start rolling off your tongue like your name. But what I want you to do is to create a table like this, buyer-seller on the side, calls and puts across the top. If the buyer has the right to buy with a call, what does the seller have? Think opposites. It's the obligation to sell. Look at this. Obligation, opposite of buy is sell. Now you can figure it out. Say, the seller must have the obligation to sell. And again, over time, that will just start clicking. What about a put? Pretty easy to start with the buy side. The put buyer has the right to sell. What do you all think the put seller has? Would be the obligation to buy. Okay, check this out again. Opposite of right is obligation. Opposite of sell is buy. Okay, they're just on the opposite sides of the trade. Some other terms we need to know to talk about options: intrinsic value and time values. All option prices can be broken down into two components called an intrinsic and an extrinsic, or a time value. So, for example, we might see this option trading for 8. And I might be able to say, well, there's $5 of intrinsic value and $3 of time value. Or maybe there's $3 of intrinsic and $5 of time. Maybe there's 0 of intrinsic and all time. But we have to understand how to break these option prices down. But the one thing I want you to see right now is that if you take the intrinsic value, 5 in this example, plus the time value of 3, it always adds up to the option's total price. That's what do I mean when I say break them down into two components. So how do we figure out the intrinsic value? Let me show you an easy way to do it. Think of the phrase immediate benefit. And the size of that benefit shows the intrinsic value. So for example, if the stock is trading at 110 and I've got the $100 call, think about it. I've got the right to pay $100 for something that's worth 110. That sounds like a pretty good deal. Free $10 in there. Well, we all know there's nothing free in the markets, and that means you're going to pay for that up front with $10 of intrinsic value. The time value is what's left over after we've accounted for the intrinsic. So let's do an example. If the stock is 105, and let's say we look at a $100 call option, that's our strike price, and we see that it's trading for 8. How much intrinsic value is there? I have the right to pay 100 for something that's worth 105. Is that an advantage? Is there an immediate benefit in that option? Sure. $5. There's $5 of intrinsic value. What's left over? Well, the option's trading for 8. I can account for 5. That means $3 must be time. So again, a nice little mnemonic is think of the formula PIT. Option formulas or math formulas are the PITs. P minus I equals T. That means the option premium minus the intrinsic gives you the time. So again, in this example, $8 premium minus $5 intrinsic means the option must have $3 of time. Now, you're probably thinking, what's the point of all this? It's some worthless exercise. Not true. The only way that you can make use of every single option strategy is with the interplay of intrinsic and time values. And so we have to know what they are in order to employ the right strategy. So right now you're probably thinking, what's the point of this? Trust me, it will be very, very important once we start talking about strategies. Okay, but I just want everybody to at least know what the time value means when I talk about it. All right, I said at the beginning this is going to be a two-part presentation, and that was the first part just to give you the basics of options, what they are, some of the key terms that we need to talk about. Now it's time to get into the real heart of tonight's presentation. What is the advantage that we get? How can we use options in volatile markets? Why should I consider options maybe in addition to stock or maybe instead of stock? Those are all good questions. And the first thing you want to take a look at is a profit and loss graph or a profit and loss diagram. I always teach these in depth because there's no way you can properly teach a strategy or a comparison of hedge rolls and morphs unless you can look at pictures. So I know some of you go, ooh, graphs, I don't like them. Trust me, it's going to make things a lot easier. What this is we're looking at the stock price across the horizontal here, okay, 85 to 115, and then we're looking at the various profits and losses that would occur at these different stock prices. So what we're looking at here is could be 1 share of stock or 100 shares of stock purchased for 100. So notice that if we line up at 100, it lines up at 0 profit and loss. So if I buy stock for 100 and sell it for 100, I broke even. That's what this horizontal white line is. That's my break-even point. What if the stock goes to 105? Look at 105, trace a line up to the red line, and look at that. Lines up with a $5 profit. Isn't that true? 5 shares at 100 goes to 105. You made $5 per share. So the important thing to notice about straight line, and that is dangerous. You're taking all of the good with all of the bad. We're going to find out that options can partition this. Let me show you an example. Now this was just clipped today. Home Depot trading, I'm just going to call this 180 up here just for round figures, but trading about 180 bucks. Now let's say we wanted to buy 100 shares of Home Depot. What's that going to cost us? $18,000. What could I do to become better? Well, let's take a look at different strikes. You're probably wondering why I'm looking at something so low. Most people would think, well, why aren't you buying the 180 strike or the 185 or the 190? That's what most people look at. That's usually more on the speculative side with options. This is a strategy that's called stock replacement. And what I'm going to show you is one of the most powerful ways to use options for you as stock traders by using options. Now watch this. I'm going to look at the 145, and we see that it's trading for about $39. Okay. I'm going to round this up to 40 just to make it easy. Over here in these columns, look at this. Intrinsic value and extrinsic value. That's the same as time value. Notice that there is $4.62 of time premium. That's what we want to keep our eye on, because it's the extrinsic value that makes an option. And this is going to help us to understand the trade-offs. So, let's say if you bought the shares of stock for 180, this is what your profit and loss diagram looks like. Dangerous. One of the things that we always teach in financial risk management is to avoid, or at least understand and recognize, situations where you can make it all or lose it all. And look what long shares of stock are. You can make it all or you can lose it all. Well, we can do better than that. So if I use my 145 call option, this is what my profit and loss diagram looks like for a long call. Notice it looks, and the bend right here, this little elbow, lines right up at 145, our strike. It's another key insight about options. Options give you the ability to bend your risk graphs. That's what makes us, or allows us, to shape the risks that we're willing to take, and or the rewards that we want to chase against the risks that we're willing to take. So you can't do that with shares of stock. Now, you might be able to say, well, I could do 100 shares versus 50. True, you'll change the slope of it, but you still have a straight line. Either make it all or lose it all. It doesn't change the risk because it's still the same stock. It changes the amount that you have at risk, and those are two different things. So do you see how this looks like a hockey stick? So this is what we call an asymmetrical payoff. The right half of the graph, if we draw a straight line down to this elbow, the right half of the graph does not look like the left half. It does for shares of stock, it doesn't for an option. So the real benefit is if we overlay these two graphs. Take a look at this. The red line, stock. The green line is the 145 call that we looked at. What do you notice? First thing that stands out like a sore thumb is we got rid of all of this downside risk. Option trader, most we can lose is what we paid. It's true for all financial instruments. Limited liability. Most we can lose is $40. For the option trader or the stock trader, if you paid 180, theoretically could go down to 180. Not certainly lose a lot more than 40. However, did this come for free? No, it didn't. Take a look at those two lines up here on the right side. Those two parallel red and green lines. You see that little tiny sliver of a black space between there? What do you suppose that is? That's the $4.62 of time premium. The time premium shifts our break-even point forward a little bit. So what we've done here, $4.62 of the upside. Now this option was good for almost, it was January of 19, so almost another year. We've given up $4.62 of the upside in exchange for sharply reducing the downside. Let's take a look at what else we get. I'm paying $40 instead of $180. I'm paying 22% of the stock's price. There's no margin interest. For any of you who trade stocks, know that if you go on margin, got to go 50%. Unless you've got a ton of SMA in the account, you can go 25% as a pattern day trader down to 25 intraday, which means by the end of the trading day, you've got to be out. I can keep you at 22% for a year. And you've got no margin interest. You have no maintenance calls. Okay, so again, pattern day trader only gets 25% intraday. So lots of big advantages. Now, sometimes somebody might say, well, I don't know if giving up $4.62 is worth it. Fine, go to the 140 strike. And we'll find out when we talk about option theory that time value, that extrinsic value, has to be less. Okay, let's actually a few screens here. Take a look at this. What if we went to the 140 strike? Look at the time premium. It's now $3.67. $2.97, $2.45, $1.12, 82 cents. I can make the time value as small as I want, but I'm going to have to pay more intrinsic value. So it's a trade-off. But what I'm trying to show you is just that's the beauty of options. You can create your own risk-reward graphs. You cannot do that with shares of stock. The same thing. Now, finally, we also get another little bonus called gamma. And we'll talk about this, and in the trading class we'll talk fully about what are called the Greeks, which are sensitivity measures of options, but gamma is one that is really misunderstood. And gamma, because of the way an option behaves, it starts losing less on the way down, but accelerates on the way up. And so take a look at this graph. Here we've got 50 shares of stock in red and one call option in green. So if the stock is right here around 100, both of these assets are behaving like 50 shares of stock. And I just know somebody, Bill, said, what about, was it Bill? It said about delta. Yes, Bill said about delta. That would be the delta. The red line, 50 shares, have 50 delta. It's behaving like 50 shares because that's what it is. The green line, even though it controls 100 shares, right now it's behaving like 50. And if the stock starts going up, look what happens. We start generating or manufacturing deltas. I will eventually have 100. If the stock falls, I will have less. So take a look at what this graph is doing. What do you all see that's interesting about it? As an options trader, I can make more than you as a stock trader if the stock goes up, but I can lose less if it goes down. And my trade-off is the time premium. So now it's a question. See, it starts opening up the possibilities. Jim might not like 462 time premium. He might like 3. Fine, take the 145 or the 135 strike. But we can make these things anything that we want. And see, that's something you can't do with shares of stock. What's another big benefit? What about IRAs? You could have all the money in the world, but you can only fund an IRA with so much. What do you do then? Most people say, well, I really want to buy shares of Apple, so let me go buy this little cheap penny stock and hope that it goes up because it's the only thing I can afford. What sense does that make to take your second, third, fourth best pick? Take your best pick. When we get to vertical spreads, you can trade shares of Amazon.com for $300. You're not going to be able to profit in an unlimited fashion if it goes up, but at least you can profit somewhat. I can partition that risk-reward graph. So for everybody who's trading in IRAs, wonderful, wonderful trading tool to limit risk and still create your own risk-reward profiles. Now let's talk about trade adjustments. This is one of the other benefits I talked about at the beginning of the webinar here. Now remember, I'm not trying to give you all the ins and outs. I just want you to understand the benefits and some of the hidden benefits that most people don't even understand about options. Options we can adjust as time goes by, as volatility changes, as the stock price changes. That's the big one, especially after today. We can make adjustments. What do you do as a stock trader? Oh, man, look at that big hit. Well, it looks like I'm a long-term investor now. There's really not much you can do. We can as an options trader. There's a lot we can do. So what is a trade adjustment? A trade adjustment is an order that we place, or a series of orders, that is used to alter the risks and rewards, but maintain shaped profile. If I want to change the shape, that's actually called a morph. Okay? So if we adjust by altering the profile's shape, that's what we call morphing. We can do all this with options. So let's take a look at an example here. Now you think eBay will rise over the next several months and want to buy 100 shares. How can you benefit from using options? Now this is an example I did way back in the day with Steve, but it's such a great example, I've kept it in here. But here we had, and what do you all know from Steve's class? Look at this over here. Bull kicker off of a major moving average. What can we expect from here? Well, what we do know is if you end up buying those shares of stock, try and profit from that. This is what you look like. You can make it all, you can lose it all. It's high risk. What can we do with an option? Well, this is a little bit more of a short-term trading type of a trade. We don't need to go super deep in the money. In fact, this only had a few days till expiration. But look at the October 35s, trading for $330. So for $330, look at what I did. I'm now sitting on that yellow line, nice and safe. I don't have all of this risk down here. I've completely erased that. But there's hardly any difference between the red and yellow line. I'm basically holding shares of stock. But I'm doing it for $3.37 instead of $37 and change, or about 8% of the stock's price. Try telling your broker you want to put down 8% margin. Not going to work. I can do it with options. $330, what is it for the stock trader? Again, that might be a bit of an exaggeration, but remember Enron, it can happen. And I know a lot of people say, it never happened to me, I'd get out. That's what a lot of people thought with Enron. You take a 50-point hit on that stock. You're not going to want to pull that trigger. Well, I'm sure it'll bounce back. In fact, a lot of people would buy more. And then it takes another hit and another hit. And then you finally hit a point, well, I've pretty much lost everything. I might as well chance it. And then you do end up losing everything. It's a cycle. So, again, even though that's an extreme theoretical limit, it can happen, and it does. But at a minimum, do you all at least agree that $330 is easy to lose on a $37 stock? Sure. I don't have that. I know up front, absolutely 100 positive, guaranteed that's the most I can lose. I know some people might be saying, what about a stop order? Stop order is not the same animal. When we start talking about classes, one of the things I teach in financial engineering classes is that a stop order is a path-dependent tool, and an option is a time-dependent tool. If that doesn't make sense, it will. But what I'm telling you right now is they are not the same deal. You cannot compare a stop order to an option. So the only way that you can guarantee that you, in this example, lose $330 is by the option buyer. Now, what do we expect from the option? We see a bull kicker in general, at least off of a definite trend, but especially off a major moving average. Usually expect it to bump up there. And look what happened. Next 4 candles went up. What do most people do? Sell. Get me my money. Find something else. What's the problem with that? What makes you think the thing you're going to put it in is any safer? You're still in the markets, just a different ticker. It looks like it's working for us. Let's stay on, but let's manage the risk. What do? Here's where we do a roll-up. This is a trade adjustment. Now, notice that my option went from 3 and change to 640. 330 to 640. So I could have taken the 94. I'm sorry, that if I did sell it, that would be a 94% profit, but the stock only moved 10%. So now we're seeing some big leverage. Why? Because what we're really doing as an option buyer is we are the stock price, a little bit like a layaway plan. If you buy the stock, you got to fork over the whole price. As the option buyer, mathematically what I'm doing is I'm paying $640 down and I'm floating $35 till expiration. Of course, I never have to pay that. I can just close out the option. But this is where the leverage comes in. And what's beautiful about this, it's a mathematical leverage. It's not truly borrowing money. That's why you can't get a maintenance call or margin interest. So what are we going to do for our roll-up? Instead of selling it, what's the mantra we talked about? Trends last longer than people expect. Let's stay in it, but let's just not be dumb about it and watch it go to zero. I'm going to take my 640 call, or my 35 call, and sell it for 640, but I'm going to simultaneously buy the next higher strike for 440. Now, in the real world, we could trade between the bid and ask at the mid and get better prices, but that is a net credit. It has to be a credit every time you roll up a call or roll down a put. We'll talk about that when we get into pricing principles. But just suffice it to say that lower strike calls have to be worth more because they give you the right to pay less for the stock. So if I roll from the 35 to the 37.5, I absolutely positively must be getting a credit. And that $2 goes directly to my money market, but I'm still in the position. Okay, so what happens now? I don't have 330 into it anymore. What have I done? I've now shifted my profit and loss curve up. That's why it's called a trade adjustment. It has the same shape, but I've just shifted it. And what I'm doing is I'm putting profits in my pocket. I'm reducing the risk. So what happens here? Oh, I'm sorry. Where's my? There's our screen. So here's what happens. See, now you're looking at those little 4 candles down here. You're not feeling like such a hero anymore. This is where the real money lies. Trends last longer than people expect. And so, somehow the slide got reversed. But what I would do on this last roll is I would slide my profit and loss diagram completely above 0. I now am, in a sense, playing with house money. I got all my money back and a guaranteed profit, and I still have control of the shares. And from here, I can go into back spreads. I can morph into vertical spreads. I can do partial verticals. I can do ratios. I can do all kinds of fascinating things that do nothing but shift this curve up, but still give me unlimited potential. That's where the money's made. Okay, so that's when you see stuff like this. That's how you're going to have the nerves to hang on, still grow your account. Stock repair. Let's do this one for a final one. Actually, I got 2 quick ones right here. Stock repair. Let's say you own shares of stock that have fallen. You kind of would like to get your money back and get out. That's really your goal. You're thinking, I really wish I hadn't done this. I'd love to get my money back. Not looking to profit, but you're trying to accelerate the break even. All right, so to do this strategy, you have to be at least mildly bullish. But what are we going to do here? So let's say 200, stock's now at 193. I can do what's called a 1 by -2. It's a ratio spread. Buy the 190 call and sell the 195. Actually, a vertical spread. Okay, but we're just doing it as a ratio. So what happens here? Yeah, technically what I'm showing here is that we actually have a vertical spread plus a covered call is really what's happening. So it's not really a naked call because I've got the shares. So here were the quotes. I buy the option for $7.45. I sell the 2 for $4.55, or a total of $9.10. Notice that the amount that I received exceeds the amount that I paid. So I get a net credit of $1.65, and now I have shifted my profit and loss diagram from that really ugly buy up near 200. Look at where my break even is now. And I still can make a little bit of profit, but I've greatly accelerated where I'm going to break even. What if I did a different pair of strikes? We get different shaped, different positioned risk-reward graphs. Now in this case it would cost, but I would still get a bulk of that back, but I would get it down here at 185 instead of at 200. I'm telling you, the possibilities are endless. I've been doing this every day of my life since 1990, and I'm still fascinated by all the things that can be done. I could talk about this stuff for just hours. I find it really interesting when you start understanding the details of what options can do. So, what are they doing here with this one? Let's say we have stock at 50. You buy the $50 call for 2, it now falls to 48. And we say, you know what, it's turning bearish. Well, maybe I could sell the $45 call for 4. I've now gone from the red graph to the green. This is a morph. Notice that the shapes aren't the same. Red one looks like a hockey stick. The green one looks a little bit like a letter Z. It's a vertical spread. But I've morphed it, and I did it for a credit. Can't do that with shares of stock. All right, final one. Just a couple minutes. This is one that will really open your eyes to just how powerful options are. It's one of my favorite strategies, selling spreads against shares of stock. This is actually from a client that we had at a previous firm, so the quotes are a little old, but that's why I saved these slides. It's really a fascinating case study. But the guy had 500 shares of Walmart at 53, and it was now trading for $56.50. He said, you know what, I'm afraid of losses, but I don't really want to buy these puts, and I don't want to give up my unlimited upside, but I would like to somehow protect the downside. Well, good point, understandable. Here's his current profit and loss diagram. What is that? High risk. Make it all or lose it all. So he's already got the long 500 shares in yellow. What did we do? We bought 5 puts to protect it. That's our insurance policy. We've got the right to sell those shares for 50, no matter how low that stock price falls. But now I'm going to sell 10 vertical spreads against that. And you might think that we have some naked positions in here, but you'd be forgetting we've got these 500 shares to cover it. So here were the prices at the time. Buying 5 puts cost me $275, $3,200. And from that big credit, I take that to buy these 60 calls for $850. The total net credit is $2,075, almost $2,100 immediately in his account. What do we do to the profit and loss diagram? We went from that risky red line to this. We can't lose. We still have unlimited upside. I've got this nice big credit if it sits still, and I have a little bit of a profit if it falls. Now, the reason we did this, it looks like an arbitrage, but that's because he'd been holding the shares for a while. But the main point I want to show is that why take excess risk? Get yourself into these positions if you know how to do it. Is there a trade-off? Sure. If we overlaid the stock against that position, you can see that he still has unlimited upside. This green line angles off here to the right in an unlimited fashion, just like the red, but it doesn't come into play until 60, as opposed to about 57. It's a trade-off. But every single month that he does this, he's going to take that roughly $2,000 credit and shift this green curve upwards, getting safer and safer, but still having unlimited upside. Okay, so this right here is your trade-off. What if I wanted to do, instead of doing, what do we do, a 1 by -2, I did by 3. Well, now I'm going to do this. Profits to the downside in exchange for maybe having a little loss down here, but I still have unlimited upside. Is there a trade-off? Sure. That's what we look like on the long shares of stock, and I've now morphed it to this. I can make a boatload if it falls, but I can make an unlimited amount if it rises, but it does have to rise significantly. What if I bought puts on the bottom? Actually bought another 5 puts down there. Now I look like this. I'm going to make money if it rises, if it falls, and if it's... Is there a trade-off? Of course, that's what we've moved from. But look at where the trade-off is. I'm giving up some, not all, of the upside in exchange for locking down some profits. That's what I want you to understand from this webinar. That's what options do. Can we use them in risky ways? Of course. But that's not where we're going to start. It's not what I teach. So for the highlights for tonight, options allow you to alter your risk profiles. That's important. You can hedge risk, quickly change directions, and create monthly income. Why? Because there's a time premium. Options allow you to hold on to positions much longer and capture those long trends safely. And so with that, I hope it gives you a little survey of what options can do. And Steve and I are teaming up to also offer the Alpha Trader course and Strategy Lab. Alpha Trader is, I call it Alpha Trader because it's the beginning. And we go from the very beginning. And even for people who have been trading options, I promise you the things even at the entry level that you've never heard of. We're going to talk about leaning on the book. We'll talk about, like I talked about, time-dependent paths and price-dependent paths that you have to understand to succeed with options. And then we get into pricing principles. We get into the Greeks. Just start walking you up that ladder. We close with 3 strategies that you can use: stock replacement, which we touched on tonight, vertical spreads, and covered calls. And finally, for those who might be a little more well-versed with options, you can go into Strategy Lab, which just gets into the strategies, the hedges, the rolls, the morphs, but it assumes that you understand what we're talking about. If I say time value in Strategy Lab, I'm not going to stop and explain what that means. So if you're brand new, you want to start with Alpha Trader and then eventually kind of morph your way, so to speak, into Strategy Lab. If you're interested in that, you can stephenbigelow.com/alpha for more information. So I want to thank everybody for being here, and I believe we've got time for Q&A. Is that right, Steve? Is that what we're going to do here?
Whoops, trying to
questions.
Yeah, take as much time as you want. Everybody, this is an opportunity to ask questions. from one of the, what I would consider one of the top option experts in the nation. So, yeah, take your time. We're sitting here where it's warm and cozy, so we'll just keep listening.
I appreciate that, Steve. Thank you so much. And, yeah, so let me back up. It says, what vertical spread was sold for Walmart? And that was, well, there's several of them in here, but I think you're talking about this one right here. This is actually what's called a ratio spread. But if you did that ratio spread by itself, which are just the two trades in white, you would have a naked position of 5 contracts. You'd have a net contract exposure of minus 5 contracts on the right wing. But because you're long 500 shares here, you don't. Can we draw on this plot? I think we can. Let me see if I can actually do it here. Let me try this. If you did the 1 by negative 2 by itself, everybody seeing that? You would actually look like this. You would have unlimited downside. It's a ratio spread. But when we combine it with the 500 shares, we don't have that. So these two strategies by themselves give you a net 500 shares, or negative 500 deltas, but when we compare it up with here, we actually have net flat through that zone. Reduce my screen size. It's a good question. I don't know how to do that. John is asking an opinion of cryptocurrencies. Cryptocurrencies, right now, in my opinion, they are a fabulous speculative tool. I'm not a believer in the thinking that they're going to take over currencies anytime soon. I like the idea. I definitely love the idea of a blockchain. Many other techniques and uses for blockchain, everything from shipping, even things like the Tylenol scares we've had in the past, theoretically would not have happened with a blockchain. We can track that at every single step. So blockchains aren't just for cryptocurrencies, but it's nice that that technology is developing. But right now there is so much uncertainty with it. I would consider it a good speculation tool, but go into it easy. But it's not a currency or an asset yet. Is stock substitution like stock replacement? Ken, it's the same thing. Stock substitution or stock replacement is a strategy that we teach that it's using an option to behave like shares of stock. So let me actually go back to that screen here. Where was it? Right here. When the stock was trading up here, let me go back to the okay. So here was the Home Depot example, and the stock was trading up about 180. So it's trading up in here. But notice that I've positioned these angled portions. These are my delta portions to mirror the stock. See, if I measured it, if I put it down here, if the stock was trading around 95, I'm not behaving like stock. In the options business, we'd have a very large gamma position. Actually, down here would actually be a low gamma, but would eventually become a large gamma. You need that stock to make fast, aggressive moves. I don't need that up here. I got very little theta, very little time decay. It's shares of stock. And the reason is that I've structured this to put the current stock price right in the middle of these big deltas, up and down. Yep. So if the further I go in the money, then the less that time value becomes, because the market's saying this is becoming more likely to. And in fact, if we go deep enough in the money, you would. If there's not a lot of time to expiration, you'll definitely see some. Try some tomorrow. You'll see some that will have extrinsic values of 0. If you're going for a 2-year option on a volatile stock, it might not get to 0, but you could probably get to 40, 50 cents, 70 cents. But for all practical purposes, at 0. That's stock. In fact, another neat little trivia question that most people don't know, I teach it in the classes, that an option, theoretically, option with a 0 strike price and unlimited time to expiration, it would trade for the price of the stock. So mathematically, those who buy shares of stock are buying an option with a 0 strike and unlimited time to expiration. but think of how little sense that makes if you say I'm going to be in this trade for 3 months. Why do you want an option with an unlimited time to expiration? Get the one that's got the 3-month expiration, and let's get a trade-off in risk and reward. We could all argue about which is the best trade-off, and you know what? We could all be right, because we'll just select different strike prices. But you have to understand what you're looking at, but that's the idea behind it. That's a very good point. Now, CB is saying, problem, stocks go down without warning. That is absolutely true, but what I show in the classes is that the option trader is worse off down to the strike by the amount of the extrinsic value. That's it. Beyond that, the stock trader loses dollar for dollar, and the option trader loses nothing. So again, it's a trade-off. So if you want to say if the stock falls to a certain level that I only want to lose $5 or $8, I can do that with an option. You cannot do it with the shares of stock. So if you want to buy, let's go back to the examples here. You could run through some examples. If we bought this $110 call that has 82 cents of extrinsic value, remember I said that's what we want to keep our eye on. If I bought that option and you bought the stock, you pick any stock price in the world down to 110, and I am worse off than you by 82 cents. That's it. You pick stock prices below 110, and you are far worse off than me. So I'm giving up 82 cents of upside, and I can get that for $70 instead of $179. Still a good deal. But then you have to say, well, gee, do I really want to give up just only 82 cents? Could we live with $1? What about $2? I'm only paying 56 instead of 70. I only teach an 80 to 85 delta, which is why I selected this 145. I know I didn't explain it in the webinar, but that's why I kind of landed on this one. It's really where your risk-reward trade-offs become, I don't want to say optimal, but in most people's views would be the one that would feel most comfortable. Good questions. Any others? When buying naked call or put, where is the sweet spot as far as delta goes? Jake, that is a difficult one to answer. By the way you phrase it, my favorite answer in options trading, you'll know, is always it depends. Because I could tell you situations where an 85 is the best. I could tell you situations where 100 is the best. If you're maybe doing a diagonal spread to make it behave like a covered call. 75 delta is not going to cut it. You're going to roll over and end up with negative deltas on the high side. What about for an options trader who's looking for big, aggressive moves, around a 45 or 50 delta? I want to maximize that gamma. That's more of a gamma trade. And a lot of people who are familiar with straddles all think it's a bidirectional trade, and in a sense it is, but it's really a gamma trade. It's looking for acceleration. So when you're saying what is the sweet spot as far as delta goes, to give you a short answer, if your outlook is, I think the stock is going up, I would at least try to get those deltas up. 65 minimum, 70, 75 would be preferred minimum. If you think the stock is going to go up aggressively or fast, you want to start including some speed words, what I call a speed component to that option, which is measured by gamma, then I would start taking it more towards at the money and possibly out of the money. Could you give an example where you buy a covered call and other options, like you demonstrated, to protect that covered call no matter where the stock crashes or zooms up? Sure. What you want to do, let's see if I can get a, let me just do this real quick. Is everybody seeing the black? Okay. When you have a covered call, it is synthetically the same as a naked put, which is why we don't really like it. Although if you're going to do covered calls, it mathematically would make more sense to do a naked put. But your profit and loss diagram is going to look like this. Now, if you bought a put underneath it, We could get rid of this, but that's actually what's called a vertical spread. Why take 3 options, or 3 positions, stock, short call, and long put, to get this profile when I can do exactly the same thing with 2 as a vertical spread, a whole lot less money? Again, because we're floating that strike price. But if I wanted to actually make money, I would have to buy another put down here, and I could bring this up this way. And that is a back spread. Okay, so again, I could get the same thing by just selling a put here. I could sell maybe a $50 put and buy 240 buy 2, exactly the same thing. So again, the only time that I really suggest that somebody buys stock or does a covered call is if they already have the shares. And they're absolutely willing to hold that downside risk. If you want the covered call because you like the philosophy of it, much better ways to go about it. Good question. I don't get the dividend if it's a dividend stock. That is true. And if dividends are part of your philosophy, then that would be a consideration. But I can also show you in most cases where it's just not going to be advantageous. Dividend's going to give you a short-term capital gain, not really a lot of money in most cases. I mean, if you've got thousands of shares of something, a different story. But you're going to find that the protective quality of that put will usually exceed the value of that dividend. In fact, there's a little mathematical formula we can do to see if a call option is a candidate for exercise. Is it mathematically advantageous to exercise it? And just to give you the short version, if the bid of that corresponding put is greater than the dividend, keep what you have. Theoretically, you could sell that put, go into a synthetic stock position, delay your exercise, keep more than you did with the dividend, and still end up with the stock in the future. You are absolutely 100% mathematically better off by doing that. And because of the volatility component, in most cases that's true. So if the put has more value than the dividend, why do we want to get the dividend? That's the argument that professional traders have. But I also understand, I would concede that there are some people who say, I've got thousands of shares of tons of stocks, and I've got it staggered, so I'm getting something just about every month or every other month, and that's part of my strategy. That's a different story. And in which case, I'd say covered call. CB, in the example for protecting a covered call puts, would you buy and sell? Another very good question. You guys are asking some really good questions. Watch this. It depends on how much risk you want to take. And the analogy there is exactly like an auto insurance policy. You just bought a $30,000 card. You want the insurance company to insure the and pay a lot for it. Or do you think you might be able to absorb a $500 deductible or a $1,000 deductible in exchange for a cheaper policy? It's exactly the same calculations. And I'm not going to say that one's right or wrong. It's a personal decision. But what would happen here if this is my covered call, okay, and let's say that I only want it to fall down to here, right, to this point. So maybe this is $50. And I might need to buy, depending on where the stock is and what my purchase price is. This might be an at the money. Depends on how long we've held it. Could be in the money, but let's just say it's maybe an at the money or slightly out. But if I'm willing to write it down to here, this might be the $40 put. And in a sense, I could say that's an additional $10 deductible. And in exchange, I'm going to pay less for that put than I would for the $50. I mentioned during the webinar that lower strike calls have to be worth more money. Higher strike puts have to be worth more money because you've got the right. Just happened to my screen. You've got the right to sell the shares for more money. There it is, with higher strike puts. So if you're going to buy lower strike puts, you're going to actually get cheaper prices. Now here's something else that's very, very interesting, and I used to do this a lot on Active Trader. We'd have clients that would have, let's say, maybe an IRA, And they'd say you're not allowed to take a bearish position. But we will let you do a covered call, and we will let you buy a put for protection. So here's your shares. If this is the, let's say, the short 55 call, there's my bend right there, and maybe this is the long 45 put. If I switch these two, if I make that the 45 call and this the 55 put, guess what I do? I reverse this profit and loss diagram. I'm going to actually look like a bear spread. So, I mean, think about that. You're in a place where they say you are physically not allowed to do a bear spread, and I can put you in a bear spread because I understand options, and it's always about how we hedge the deltas. Used to do it all the time. And this is why I get so excited about talking to traders about it. You're going to see aspects of options that you're, most as you buy it and it's, hope that it goes up and sell it. And that's really just is not doing it justice. They are far more powerful than that. The various strategies, a lot of them are in the Options 101 book. But it's always nicer when you got the hand-holding to go through and ask questions and, even like we're doing here, go into different tangents and different topics. But a lot of them are. What are some tricks to deal with high volatility making option extrinsic value expensive? Well, one thing is that we can sell some volatility. All right, so if you have an option, one thing that I do right now for a lot of clients, I do have private clients as well, but if I do this, well, I don't have the quotes for it, but think about this. You've got 10 contracts of something that's a year and a half out, and you say, I have, I'm going to get hit with $200 worth of theta for the week. That's how much my option's going to decay through the week. Well, why don't we come and sell something off that's short term, maybe a week or 10 days, and I can sell maybe 2 contracts that points out of the money and collect my $200. Technically a diagonal spread, but I'm not using it as a diagonal. I'm using it to offset the theta and to offset the volatility. Okay, so that's a good question. But yeah, volatility hedges are something we look at because that's what the market's all about. And that's really what gives an option its value, is volatility. Okay, now another little tip for everybody out there. I hear a lot of people talking about hedging time. And I remember there was even a service that used to call it time traction, and they would try to sell off something to eliminate your time value. It's not a good idea to hedge time. Why? It's a known. It moves in one direction at the same speed. You want to hedge unknowns. And so traders that are hedging time are completely just barking up the wrong tree. It's just not a good strategy. Listen, I would certainly try. So the website is stephenbigelow.com/alpha, ALPHA, and I understand there'll be more information about that, but you can certainly contact us. I believe Steve is going to have me in. Do you have a day trade, a room during the day? I think the Candlestick Forum, and talk about some option strategies in there, and love to come in there. And you can tell I get excited by it, by talking about options, because it really is fascinating. And I've had clients who have been trading for 30 years and showed them stuff and they said, nobody has ever shown me this before. I never knew this could be done. And that's what happens when you just learn some simple strategies and think that that's the end. It just isn't. The options go so deep and they're so powerful, which is why they're becoming more and more popular. Every year the SIBO just increases volume, just sets new records. The more volatility we see in the markets, the more you're going to see them. I do have a website that's optionsatoz.com, and I'm pairing up now. The classes that I have offering here are on my website at a much higher price. So Steve is doing a deep discount for all of his traders. Where'd my website go? But There it is, optionsAtoZ.com. So the tagline is teaching the art and science of options trading, and that's really how I view it. There's an art side to it, and there's also a science side. And unfortunately, a lot of people skip over the science side, the traps. I could do an entire book on just option traps, misperceptions that people have about options and thinking what's going to happen, and it just isn't. Covered calls are a great example. I've had traders that say, I bought stock at 100, I can sell this option for 10, I'm going to make 10% on my money. Well, it's in the money by $9. You're only making the dollar. You're making 1%. You say, no, I'm not making 10, I'm selling the option for 10. Yeah, but 9 of it, you're giving somebody else to buy that, the right to buy your stock for $9 less than it's currently trading. So they're compensating you that up front. That's a wash. Your net benefit is that dollar. Lots of traps to step into. I don't think any part of options trading is difficult. It's just that there's a lot of stuff to know. You have options alerts, i.e. vertical spreads. Wally, I'm sorry, I'm not quite sure I understand the question. In the meantime, Ronnie, is how do you present your program? The program is online. I used to do it live, and it was, as you can imagine, very difficult to get everybody, different parts of the world in the room at the same time. So they are all online. I think we said there's about 30-something hours of training. They have menus, so you hover over the side. The slides look very much like the ones you're seeing here. Kind of my company look and feel. And if you hover over the left side, you'll see a menu. And if you click on that, it'll take you to that portion of the video. So that kind of gives you a way to and come back later. But it's all presented right there. Take it very slow. Lots of examples. Real trading examples with real platforms. So I think you would definitely get a lot out of it. I'm a very big believer. I know a lot of people just get on and they just like to talk about it, or imagine this, or pretend that this is and there's no visuals. I put visuals in everything. And if I'm looking at a platform, I didn't do it tonight because I'm not on the recording software, but I zoom in and I want you to see it. And there it is. And I'm going to print it up here so we can keep track of it. It's going to just literally take you by the hand and step you through the strategies and the concepts. Program only training. Do you send out recommended option trades? Well, I don't do recommendations, although it's a possibility that might be something that we do in the future. It's something that Steve might be willing to do. Right now, it is just a training course, and I will also do weekly. I believe is what we've settled on so far, to do weekly Q&A sessions. And even in my Q&A sessions, I always bring something to the table. I'll say, here's kind of today's topic I want to talk about to get some of the, conversations going, and do a little mini presentation for 10 or 15 minutes, and then spend time in there answering questions. Yeah, CB, the night owls, I know I need to take that out. The night owls, I'm actually not doing now because I've just been so overwhelmed, especially with some ghostwriting books. But night owls was a lot of fun. We'd do them at 10 o'clock at night, stay in there till 11, 11:30. Used to put 100 people in there. They were free. So it's I'm hoping to get those started again. But we're going to do it's a similar type of format with Steve. We'll do Q&A. You want to ask about specific strategies. It's going to be a wide open forum. Question is, doing simple puts and calls a good idea in this market? Much better than doing long shares of stock or short shares of stock. I can guarantee you that. Now, because of what we talked about with options, there are better ways of approaching it by using calls and puts. So it's kind of like good, better, best. Calls are going to be absolutely fine in markets like these. They thrive. This is what they're built for. But depending on you and your risk tolerances, we can maybe do something better. Yeah, I know during the day it is a little difficult, although I'm sure that Steve records them. I think that's always standard protocol for any of these webinars. AJ, Strategy Lab is not included. It's a different class, although I think Steve said they're going to offer a super special, maybe on a combination of them. So you have to check with him and see what that is, but they are two separate courses. I know you're saying, AJ said, bring up a good question or a comment. I don't need alpha. You might be right, AJ, but I'd be willing to bet that if you went in there, there'd be a lot of stuff in there you'd say, I never, ever knew about this. And the reason I like to bring that up is that what if that happens to you in the real world? Here, let me throw this question out. What do you do if you've got an option that's out of the money and the stock gaps up after hours? You know, the stock closed at $49.50. You got the $50 call, and it's now trading for $60 or $65 because of an earnings release. And it's, oh my God, if I just had one extra day, what do you do? What do you do in that case? Yeah, that's what most people would say. AJ, what would you do? All right, here's what you do. You can exercise that call, most brokers until about 5:30 p.m. Eastern Time. You exercise the call, and you go into the after hours and you short the stock. And you've now locked in that. You don't want to exercise that call because on Monday morning you're now long 100 shares of stock. It's like putting a market order at the open. But if we can short the shares, or we short the shares in the after hours, we lock in that 60 or 65 sale, we exercise that call, and they match up and we pick up the 15 points. And I can't tell you how many people I've seen that left major money on the table for that exact reason. So there's a good example. You know, even people who have been trading for 15 years, I can tell you, when you work on an active trader options team, and we had no shortage of people spending $1 million a year in commissions, I have seen everything that can happen with an option. Another example, I even talked about it tonight, the most you can lose with an option is the amount you paid. That's assuming, financially speaking, that there's this little man-made rule called auto-exercise. And if you're not careful of auto-exercise, you can lose more in the option than what you invested. Do you know about that? These are all the things that I cover. I know everybody thinks, oh, it's Alpha Trader, we're going to learn what a call and a put is. We start there for 33 or 35 hours, and believe me, it'll get deep. Different pricing principles. Lower strike calls have to be worth more. Why? Higher strike puts. An expiration option can be worth either 0 or intrinsic, 0 or 1. What's the extrinsic value? Extrinsic value can actually be broken down into two components. What are they? Why is that important? So there's a lot of things to understand that, again, most people don't realize. So just something to think about. Yeah, avoid the earnings. That's probably, as a basic rule, not a bad idea. However, I've got a client who banged out a $400,000 profit on an earnings from doing a hard roll and swapped it out with out-of-the-money options just for the earnings. Got all of her cash off the table and then left that in for the earnings. It was back when Amazon gapped up 95 points. So, you know, we don't need to avoid it. What we need to do is to manage it, and that's the key. You want to manage that risk. Okay. So, any other final questions? CB is saying, I hope it's not too expensive. You'll have to check with Steve. I remember some talk back and forth up here that aren't correct. It is severely discounted from what I have on my website. But think about this. Let's even just throw out a number and say it's $1,000. How easy is it to lose that in the markets? And if I can save you that, you know, it's the same argument with the candlesticks. I can't tell you how many times you get these candlestick formations right off of major moving averages. You know, the kicker pattern. You're going, you know, it's good information. It can save you money. It can make you money. And so is it worth paying $500 for that information? Sure. You know, one of the things I also teach when we look at information and how to manage that and how to filter it and digest it is that information only has value if it has the ability to change a decision or to alter a decision. And so if the information here, I will absolutely promise, will change the way that everybody in this room thinks about, not just about options, but about investing and about the markets. Okay, so it is good information, and I know that everybody will benefit from it. Do I have live courses at a destination? I've done some live training. Steve and I actually used to do some seminars at Seas, back a cruise along for a week in the Caribbean. Most of the ones that I do now at a destination are for other companies. If I do live seminars, like we'll do Las Vegas and San Diego and even Texas a couple of years ago, right there at Riverwalk. I would certainly, pass that along to Steve if we were at one of those seminars like that. But as me personally, I generally don't. I just find it more efficient to do it through the internet. I think it's better for everybody. However, if a group of people said we want to bring you out to Texas and do a class, I'd absolutely. Diana, yes, you definitely will. And again, it's my purpose for this presentation was just to get people that aha moment of saying, I never even knew this could happen. It was not to teach it. So when we teach it, we get into all the ins and outs, and we do examples, and we show you mathematically. Like I kind of brush through it about if I buy that deep in the money call, I'm only worse off by the extrinsic value. But why? Let's take a look at why that has to happen. And, is that a good trade-off to give up $2 to the upside in exchange for greatly limiting my downside risk and getting stock at a quarter of the price with no margin interest and no maintenance calls? And I think most people would say absolutely. And if they don't say absolutely, let's lower the strike a little bit. What about for 50 cents? What about for 30 cents? Eventually they'll hit a point where they'll say, you know what, I'm a buyer there. Fine. You found your perch, I found mine. That's what options trading is all about. Oh, Colleen says I skipped her. How long would it take to take this course? The Alpha Trader, I think it's about 33, 35 hours. So, theoretically, you could just bang through it in 35 hours. But to do it properly, it used to be taught live over the internet twice a week, Tuesdays and Thursdays, and it was about 8 or 9 weeks we would do it. I think it started out as 8 and then it morphed into 9 because we just started adding more and more. And that's just what made it difficult. So the best answer I would tell you is to take it slowly, think about it, watch videos twice. How many times do you watch a movie the second time and you go, gee, now I see why they did that or why they said that. I didn't catch that the first time. Same thing with these. Don't spend your money on it and watch it once. Watch them twice. You'll get more out of it in the second pass. So if you do that, I would say probably a good 6 to 8 weeks to go through and absorb it all. Is it a lifetime access? I'm fine. That would be a call for Steve. I'm fine with it. But there is actually a workbook. And I have not sent that to Steve, but now that somebody put that up there, that is a workbook, which is essentially the Options 101 guide, but it follows the Alpha Trader course. And so I can get that over to Steve, and that would be, it's a PDF, but it just goes through all the slides, gives you good examples in there. So it's kind of like a, I don't want to call it a workbook. There's not really problems. Actually, there are some problems, but it's meant to be more of a supplement. So read it instead of listening to the audio visual. Again, AJ, access for the videos in the website. I'm not really sure how they've linked them up, but I think Steve's guys have kind of tapped into mine. So I'm fine with that. That's what I do for all of my people. It's an unlimited thing. It doesn't mean it's unlimited to share, to stick on eBay, but for you, absolutely. You know, just it's. And I know that because people are going to forget things, and so I want to go back and review it. Good question. Keto is saying in your Home Depot example, you talked about 80 cents of time value, but what about the wide spreads for typical deep in the money options? And that's very true. However, I can also show you how by looking at conversions and reversals, we can find out what the theoretical spread is, and most of the time you're going to get picked. I'm sorry, at the mid. Let me see if I can back up to these real quick. That was IBM. Here we go. Yeah, this one at the top here is, oh, I don't have the puts. I'm sorry. I did that just to try to get the screen bigger. But you can see that the bid and the ask were $1.20, which actually is not too bad. Right? But if we looked over on the put side, if it was maybe 50 cents, I could transfer that 50-cent spread over here and look at the mark and say this is probably where I could get picked off, and through conversions and reversals and understanding put-call parity, I can figure out where that should theoretically get filled. And most of these trades are being filled by computers now. A penny or 5 cents, they're going to do it. So it's just it's a trick of just trying to figure out where that balancing point is. So if we understand conversions and reversals, we can find out what the implied discount rate is. We can find out what the spreads on the puts are. We can figure out. But as a basic rule, if you go right here between them, go $1.10 here, 70.85, I'd be willing to bet that would get picked off almost immediately, because that's the theoretical price of it. I'm sorry, 70.35, which is that mark right there. That's why we put the marks on these, because that's normally where we're going to trade. Someplace we can go for some ports, trading options for years, but need some help. Absolutely, Colleen. You're going to anybody who knows me knows I've never left anybody hanging out in the dust. People call me all during the day. I got to trade. This is, what do I do in this case? I'm not going to leave somebody hanging out there. I know that that's important, and it's part of. Steve and I are going to be doing Q&A, but you can always contact me. I will always give people, if you have questions, but right now what I want to do is to push the Q&A. I think we're talking about doing it weekly and going into the forums. And what's also magical about this is it becomes so much nicer when Steve can talk about the candlesticks, and then I can feed off of that and say, in this situation, here's how I would do that option strategy. And so that's really the missing piece that most people have. How do I find out what to buy and when is the right time, or to sell? And then how do I match that with a proper option strategy? So that's what I'm assuming we're going to be doing in the Q&A sessions or in the live trading. So all kinds of ways, but I think you're going to find that the Alpha Trader will answer most of your questions for you. That's what I designed it to do. John, do I still teach how to use the TOS platform? I do. I'm actually in the middle of, actually just re-recording some of the trade screens and trade tabs just because of all the changes that have gone on it. But I do have the TOS videos on there. Will anything more advanced in the Alpha Trader course be offered? Normally when I do that, it's private coaching, just because if they want more than that, more than Strategy Lab, they're going to be fairly advanced, and I don't really know what they're looking for. So it doesn't make sense for me to talk about classes on how to trade a skew curve, or how to trade, do volatility trades. I want to know what you're trying to do. But it's a good point. And we could certainly do that. I have no problem putting together a course. If there's something that everybody in Steve's group says this is what would be important for us, sure, we could throw that together. Absolutely. But again, what I always find, where are the mistakes always made? In anything that you practice. In the basics. If you struggle with calculus, why is that? Because you didn't get the algebra. You struggle with algebra, why? Because you didn't get the addition and subtraction. And if you struggle with the advanced topics, it's because you didn't understand the real fundamentals of options. And that's, again, what AlphaTrader was designed to do. Make sure that all those are ironed out. TH, doesn't look like Steve is offering the Strategy Lab. If he's on, he might be able to answer that. I am reasonably certain it is being offered. It might be offered in conjunction once you click on AlphaTrader. Or as maybe like as an upsell. You might want to try that. Yeah. But again, this is, I just want to, again, I want to emphasize that I think the biggest key that I bring to the table, there's lots of people out there trading options, lots of people teaching options, but I've bumped into professors who've been teaching options for 30, 40 years, have never traded an option in their life. And I've bumped into people that have an option trading website and can't answer the first basic question about an option. Always easy to trip them up. You know, what's the difference between a call and a put? The answer depends on how we delta hedge them. A call is exactly the same thing as a put. And in fact, I even show that in the class. It just depends on which side of the graph you're looking at. The profit and loss diagram for a call is a put. They're just complements of each other. And so most people say they're opposites, and they're not. They're really the same thing. It just depends on how we're looking at them. So that right off the bat blows a lot of people's minds. But again, so I like to show these things. There's a theoretical side, and there's a real-world practical trading side. And I don't know of many people that can kind of bridge that gap. And they're both important. A lot of things I teach in my class that you'll never, ever see anywhere else. And I taught the capstone class at FIU for about 7-8 years. I'm still on the list there. I've kind of had to back away just because I've been so busy with it. But I was an adjunct there teaching the capstone class for finance classes in the financial engineering department. Swaps. So you can imagine how deep that goes. And I try to bring out the concepts for retail traders so that you understand what you're looking at. I'm not going to make you go and calculate, futures fair value in the morning, or where your no arbitrage bounds are with and without commissions. That's all stuff for the classroom. But I want you to understand what it means. We need to understand that stuff. Any final questions? Pricing models. Ken, we do teach pricing models. I normally don't get super deep into them because for most people, they just want to know what does it mean to be a theoretical value. I do teach binomial models, trinomial models, just about obviously Black-Scholes. But I think what's important, that theoretically they all converge on Black-Scholes, right? Binomial pricing, if you do enough iterations, you converge on Black-Scholes. So what's the point of it? The point is you want to know what the option is worth and what the implied volatility is. Again, try to do it more from the practical trading side. Book should be on Amazon, Options 101 Theory to Application. But I would actually tell you to hold off if you're thinking about doing the class because the PDF that you'll get with it is essentially the book. I mean, they're virtually excerpts, but they've been more tailored to the class to kind of follow that. Any other questions? Stocks, futures, options, calls, puts, strategies, conversions, reversals, arbitrage. What's the difference between a straddle and a strangle? Butterfly spread. That's an important concept to know if you want to hedge, roll, and morph your straddles, strangles, and butterflies. And which is better, the butterfly or the short iron condor, and why? Why would we choose one over the other? I'm telling you that it goes so deep. And it's fascinating. So for anybody who is a true love, doesn't mean you have to be super active in the markets, but you got to love the financial markets. You're going to turn over a brand new page here in your trading career once you understand options. TH, does the class cover more than the book on Amazon? It probably covers, well, it does because of the Greeks in there. There might be, I'm trying to think. I actually think the class is going to be about the same. I think it's more of a walk through the book, but with real screens, real trading, more hand-holding.
Bill,
Stan, how come I see a lot of traders using butterflies? The main, yes. Well, I appreciate. Let me answer Stan's question. I just started answering, but the traders using butterflies because what it is, it's really a short straddle, which gets that nice big fat premium in volatile markets. But we don't want to be short the straddle and have naked options, so we wrap a long strangle around it, and synthetically, that's what a butterfly is. It's really a short straddle with a strangle wrapped around it. So it's a hedge short straddle. And that's why you're seeing a lot of people do that in these volatile markets, although there are better ways to do it. So, good questions. So I think we're at the time here. I hear Steve cutting in here. So, Steve, you want to take it over?
Yeah, thank you very much, Bill. When we did some of our option strategies earlier in last year, the one basic concept that you want to apply to any option trading is the math. The math has to make sense. And that's where you're going to find
very true.
Yeah, Bill's information is putting the math together with the risk-reward. So the combination of using candlestick signals to find the correct trade setups and the different strategies that Bill will be able to educate you with just gives you a lot of info or a lot of ammo to put into your mental arsenal of what trades are going to be the most profitable with the least risk. So you're going to be seeing a lot more of Bill. We're going to try to do some training sessions on the package that we're going to be putting out. The reason I don't have all the details is Pat has been in, I guess it was a money show in Orlando this past week. So we're going to have that all put together because, again, the reason we're so excited about having Bill joint venturing with us is because, as John says, he is one of the best option teachers that you'll ever come across. And so we're greatly honored to be working with him. So with that, Bill, thank you very much.
I appreciate that very much, and it's always an honor working with you. You are the best. I turned over a new page for me when I, worked in candlesticks from watching Steve so many times on Seminar at Seas and in all the different shows and things, and I still sent so many people to your website because I just love candlesticks. Absolutely love them. And you're right, you have to be able to merge those together. Now that you find the trade, what's the best way to approach it? So I'm looking forward to it. It's going to be a lot of fun.
Yep. All right. Thank you, Bill. Thank you, everybody. We'll be doing a lot more of these sessions. I think you're going to find the combination of candlesticks and Bill's education on the different option strategies is going to put you in very good, let's say, profitable stead for the rest of your life. So with that, everybody have a good evening. We'll see you in the chat rooms.